Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only and should not be considered financial or legal advice. Always consult with a qualified professional before making any decisions about your insurance coverage. Imagine this for a second. You're driving home from work on a quiet back road. It's dusk. You're thinking about dinner, maybe what to watch on Netflix later. And then out of nowhere, a flash of brown and white. A deer bolts from the trees. You slam on the brakes, you swerve, but it's too late. The impact is jarring. Your airbag deploys in a cloud of white powder. Your heart is pounding in your chest, but you're okay. Your car, however, is not. The entire front end is crumpled like a piece of tin foil. You call your insurance company, shaken but confident. You've been a responsible driver for years, always paying your premium on time for what you've always called full coverage. But then the agent on the other end of the line says the 5 words that will turn your stomach to ice. That's not covered by your policy. How is that possible? You had full coverage. This exact nightmare scenario plays out for thousands of Americans every single day. And it all stems from a massive, costly misunderstanding. So let me tell you the single most important secret of the auto insurance industry. A secret they are perfectly happy for you not to know. The term full coverage is a myth. It doesn't exist. It's not a real insurance product you can buy. It is, without a doubt, the most dangerously misleading phrase in personal finance. And today we're going to tear it apart. By the end of this video, you will understand exactly what people mean when they say full coverage, what this bundle of policies actually includes, what it dangerously leaves out, and most importantly, how to build a car insurance policy that truly protects your car, your savings, and your family from financial ruin without getting ripped off. This knowledge isn't just about saving a few bucks. It's about protecting your entire financial future. So if full coverage isn't a real thing, what is it? It's slang. It's a shorthand phrase that people, and even some insurance agents, use to describe a combination of different, separate coverages. Think of it like ordering a combo meal at a fast food restaurant. You don't order a number 3. You're ordering a burger, fries, and a drink that have been bundled together. Auto insurance works the same way. Full coverage is just the popular name for a bundle that typically includes 3 main ingredients: liability coverage, collision coverage, and comprehensive coverage. And the foundation of this entire bundle, the part you are legally required to have in nearly every state, is liability coverage. This is the absolute bare minimum. Now, this is critical to understand. Liability coverage has absolutely nothing to do with your car or your injuries. Not a single penny. Liability covers other people. It's the "I'm sorry I messed up" insurance. It pays for the damage you cause to other people's bodies and other people's property when an accident is your fault. Let's break that down. Liability has 2 main parts. First, you have bodily injury liability. If you cause an accident and someone in the other car breaks their arm, needs an ambulance, and has to miss work for a month, your bodily injury liability is what pays for their medical bills and their lost wages. It protects you from being sued into oblivion for the harm you caused someone else. Second, you have property damage liability. This is for the other person's stuff. If you rear-end a brand new Mercedes at a stoplight, your property damage liability pays to repair or replace their car. If you slide on ice and take out someone's mailbox in a fancy stone fence, it pays for that too. Again, it does nothing for your car. Your car could be a total loss, and this part of the policy wouldn't give you a dime. When you look at an insurance policy, you'll see liability limits written as 3 numbers, like 25/50/25 or 50/100/50. It looks like a secret code, but it's actually really simple. Let's use 50/100/50 as an example. The first number, 50, stands for $50,000. That's the maximum amount your insurance will pay for any one person's bodily injuries in an accident you cause. The second number, 100, stands for $100,000. That's the maximum total amount your insurance will pay for all bodily injuries combined in a single accident. So if you injure 3 people, the policy will pay out a grand total of up to $100,000 for their medical bills, but no more than $50,000 to any one of them. The third number, 50, stands for $50,000. That's the maximum amount your insurance will pay for all property damage you cause in one accident. Now here's where millions of Americans are driving around with a ticking financial time bomb and don't even know it. Most people just buy the minimum amount of liability coverage required by their state. But state minimums are terrifyingly low. Some states only require $25,000 in property damage liability. Think about that for a second. The average price of a new car in the United States is now over $48,000. So let's say you have the state minimum coverage. You're driving, you get distracted for 2 seconds, and you T-bone a brand new Ford Explorer. You just caused $50,000 in damage. Your insurance policy pays the first $25,000 because that's your limit. What about the other $25,000? That comes from you. The other driver's insurance company will sue you for it. They can go after your savings account, your investments, and even garnish your future wages for years until that debt is paid. One tiny mistake, and your financial life is turned upside down because you tried to save a few dollars a month by getting the legal minimum. The same goes for bodily injury. A simple trip to the emergency room after a car accident can easily cost over $15,000. If someone needs surgery or ongoing physical therapy, the costs can skyrocket into the hundreds of thousands of dollars. If your liability limits are 25/50ths, and you cause an accident that seriously injures 2 people with $60,000 in medical bills each, your insurance pays out its max of $100,000, $50,000 per person. You are now personally on the hook for the remaining $20,000. This is why just having the legal minimum insurance isn't really insurance at all. It's a gamble. You're betting your entire net worth that you'll never cause a serious accident. So, liability covers the other guy. It's the essential legally required foundation, but it doesn't fix your car. It doesn't help you if a tree falls on your car in a storm. It doesn't help you if your car is stolen. And it certainly wouldn't have helped you in that deer accident we talked about at the beginning. To protect your own vehicle, you need the other 2 core ingredients of the full coverage combo meal. And this is where things start to get interesting because these are the coverages that actually pay you. These are the parts of the policy that determine whether you get a check to fix your car, or if you're left standing on the side of the road with a worthless piece of metal. And understanding the crucial difference between them is the key to not getting that soul-crushing phone call from your insurance agent. So what are they? They are the 3 pillars of what people call full coverage: liability, collision, and comprehensive. These aren't just words on a policy document. They are 3 completely different financial life rafts. And if you're missing one when disaster strikes, you will go under. Let's start with the big one, the one that's not really a choice: liability insurance. This is the only type of car insurance that is legally required in nearly every single state in America. Why? Because it has absolutely nothing to do with you or your car. Liability insurance is for everyone else. It's a financial shield you are legally required to carry to protect the public from you. Imagine this. You're driving home after a long day. You're stopped at a red light. You glance down at your phone for just a second to check a notification, and your foot eases off the brake. You roll forward and bump into the brand new luxury SUV in front of you. Doesn't feel like much, just a little tap. But when you both get out, you see it. Your front bumper is a little scuffed, but their rear bumper is cracked, the parking sensor is smashed in, and the driver is rubbing her neck, complaining of whiplash. Your heart sinks. This is where liability insurance swoops in. It's broken into 2 critical parts. First, there's property damage liability. This pays to fix or replace the other person's property that you damaged. In this case, it's that expensive SUV bumper and the sensor. It could also be a mailbox you knocked over, or a fence you crashed through. It is for their stuff. The second part is bodily injury liability. This is the one that can truly save you from financial ruin. The driver you hit, her neck really does hurt. She goes to the doctor, needs an MRI, physical therapy, and misses 2 weeks of work. Her medical bills and lost wages could easily climb into the tens of thousands of dollars. Your bodily injury liability is what pays for her medical care, her rehab, and her lost income. If she has a passenger who is also hurt, it covers them too. Now, here is the most important warning I can give you about liability insurance, and it's a trap millions of Americans fall into. When you buy insurance, you'll see numbers like 25/50/25. This isn't just random jargon. It's your liability limit. That would mean your policy will pay a maximum of $25,000 for one person's bodily injuries, a maximum of $50,000 for all bodily injuries in a single accident, and a maximum of $25,000 for property damage. Every state has a legal minimum you have to buy. The problem? These minimums are terrifyingly low. They were often set decades ago when a new car cost $5,000 and a hospital stay cost a few hundred. Today, that $25,000 property damage limit is a joke. The average new car in the US costs over $48,000. So what happens if you tap that brand new SUV and the repair bill is $35,000? but you only have the state minimum of $25,000 in coverage? The insurance company writes a check for $425,000, and then the other driver's insurance company comes after you personally for the remaining $10,000. They won't just ask nicely. They will sue you. They can get a judgment against you, garnish your wages, put a lien on your house, and drain your savings account. Years of your hard work gone because of a 1-second mistake in a cheap insurance policy. The same goes for medical bills. A serious injury can exceed a $50,000 limit in a matter of days. Buying only the state minimum liability is like trying to put out a house fire with a water pistol. It's legally compliant but financially insane. Okay, so your liability insurance has paid for the other driver's medical bills and fixed her expensive SUV. You're protected from a lawsuit, but now you're standing on the side of the road, looking at your own car. The hood is crumpled, the headlight is smashed, and it's going to cost $6,000 to make it drivable again. Your liability insurance will not give you one single penny for this. Remember, it's for other people. This is where the second pillar comes in: collision coverage. Collision is simple. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it also covers you if you hit a stationary object like a telephone pole, a guardrail, a building, or even if you just accidentally back into a parking garage column. It's for when your car makes impact with something else, and it's generally your fault. Now, collision coverage works with something called a deductible. The deductible is the part of the bill you have to pay out of pocket before the insurance company starts paying. Think of it as your share of the cost. Deductibles are typically $500 or $1,000. So, in our example, if your car has $6,000 worth of damage and you have a $1,000 deductible, you pay the body shop the first $1,000, and your insurance company pays the remaining $5,000. You get to choose your deductible, and this is a key way to control your insurance cost. If you choose a higher deductible, say $2,000, you're taking on more of the financial risk yourself, so the insurance company will reward you with a lower monthly or yearly premium. If you choose a lower deductible, like $250, you have less to worry about in an accident, but your premium will be higher because the insurance company is on the hook for more. Without collision coverage, the entire $6,000 repair bill for your car would be your problem and your problem alone. For most people, that's a devastating, unexpected expense that could derail their entire financial life, especially if you're still making payments on that car. Your lender doesn't care that it's wrecked. You still owe them the money. In fact, if you have a loan or a lease on your car, the bank or finance company will almost always require you to have collision coverage. They want to protect their investment, which, until you pay it off, is what your car is. So, we've covered getting sued by the other driver with liability, and we've covered fixing your own car after a crash with collision. You might be thinking, great, I'm all set. I'm protected. But what if you walk out to your car in the morning and the driver's side window is smashed, your stereo is gone, and the dashboard is ripped apart? That wasn't a collision. Or what if a freak hailstorm pummels your city, leaving your car looking like a golf ball? Not a collision. What if a deer jumps out of the woods at dusk and you can't avoid it? What if your engine catches fire? A tree branch falls on your roof during a storm? Or you live in an area prone to flooding and your car gets submerged? None of these scenarios are collisions. Your collision coverage will not help you. This is where the third and final pillar of full coverage stands: comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from almost everything except a collision. It's the safety net for the bizarre, the unfortunate, and the unpredictable acts of nature and humanity. The list of what it covers is long: theft and vandalism, fire, hail, windstorms and flooding, falling objects like tree limbs or debris, riots or civil unrest, and a big one that causes over 1 million accidents a year in the US: hitting an animal. If you hit a deer and it causes $4,000 in damage, that's a comprehensive claim, not a collision claim. If your car is stolen and never recovered, comprehensive coverage will pay you the actual cash value of your car, so you can buy a new one. Just like collision, comprehensive coverage has a deductible that you have to pay first. It's very common to have different deductibles for each. For example, you might have a $1,000 deductible for collision, but a lower $250 deductible for comprehensive, since things like a cracked windshield are much more common and less expensive than a major crash. So there you have it. The full coverage trifecta. Liability, to protect the world from your mistakes and shield your assets from lawsuits. Collision, to fix your own car after a crash that's your fault. and comprehensive to fix your own car from nearly everything else life can throw at it. Together, they form a powerful shield. But here's the scary truth. Even with all three, you are not fully covered. Not even close. There are still massive, financially devastating gaps in this coverage that most people, maybe even you, have no idea exist until it's far too late. What happens when the person who hits you and puts you in the hospital has zero insurance? What pays for your medical bills, beyond what your health insurance covers? And what about all the little things like getting a rental car while yours is in the shop for 3 weeks? These pillars are the foundation, but they are not the whole house. And the missing pieces can cost you everything. So let's talk about those missing pieces. This is where the simple idea of full coverage suddenly gets complicated, confusing, and critically important. Because these are the coverages that protect you. Not the other guy, not his car, but your body, your bank account, and your family's financial future. This is the difference between an accident being a massive inconvenience and an accident being the single event that derails your entire life. To understand this, let's invent a guy. We'll call him Mark. Mark is a good driver. He's responsible. He bought what he thought was great insurance. He has high liability limits to protect his assets. And he has both collision and comprehensive coverage with a reasonable $1,000 deductible. He feels secure. He feels fully covered. One Tuesday afternoon, Mark is driving home from work. He's stopped at a red light listening to a podcast. The light turns green. He proceeds into the intersection and bam! A car flying through their red light T-bones Mark's driver's side door. It's a violent, terrifying impact. Airbags deploy, glass shatters. Miraculously, Mark is alive, but his leg is broken in several places and he has a serious concussion. His brand new car is completely totaled. The other driver is dazed but unhurt. He stumbles out of his beat-up sedan, apologizing profusely. He was texting. He admits it was 100% his fault. The police report confirms it. A clear open and shut case. Mark's collision coverage will handle his totaled car, and the other driver's liability insurance will handle Mark's extensive medical bills, his lost wages from being unable to work for months, and the long-term physical therapy he's going to need. Right? Wrong. Because when the police run the other driver's information, they discover a nightmare scenario. The driver has no insurance. Zero. He let it lapse 2 months ago. He has no job, no savings, no assets to his name. You can sue him, sure. And you might even win a multi-million-dollar judgment. But as the old saying goes, you can't get blood from a stone. A court judgment against someone with nothing is worth nothing. Suddenly, Mark is in a terrifying position. His health insurance will cover a lot of the medical bills, but he has a high deductible and a steep out-of-pocket maximum. We're talking $10,000, maybe $15,000 he has to pay right now. And what about the 2 months of salary he's going to lose while he recovers? That's another $10,000 gone. What about the chronic pain he might have for the rest of his life? All of that was supposed to be covered by the at-fault driver. But that driver is a ghost, financially speaking. This is where the first and arguably most important missing piece comes into play: uninsured and underinsured motorist coverage, or as it's often called, UM/UIM. This is the coverage that protects you from the marks of the world. It's you insuring yourself against the irresponsibility of others. And it is absolutely non-negotiable. Statistics show that as many as 1 in 8 drivers on the road in America is uninsured. 1 in 8. That means every time you drive to the grocery store, you are sharing the road with dozens of people who have no ability to pay for the damage they might cause you. Uninsured motorist coverage has 2 parts. The first is uninsured motorist bodily injury, or UMBI. If you are hit by a driver with no insurance, your own insurance company steps in and acts as if they were the at-fault driver's insurer. They pay for your medical bills. They pay for your lost wages. They pay for your pain and suffering. They essentially take the place of the insurance company the other guy was supposed to have. In Mark's case, if he had UMBI coverage that matched his own liability limits, his insurance company would have written him a check to cover his medical deductible, his lost salary, and compensation for his injuries. It would have saved him from financial ruin. The second part is uninsured motorist property damage, or UMPD. This covers the damage to your car. Now you might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. If Mark has collision, his insurance will pay to replace his totaled car, minus his $1,000 deductible. But here's the key difference. UMPD often has a much lower deductible, Sometimes it's $250, sometimes it's zero. So instead of being out $1,000, Mark might be out only a couple hundred or nothing at all. It's a small detail that can save you real money. And what about the underinsured part? This is just as important. Let's change the scenario slightly. Let's say the driver who hit Mark did have insurance, but he only had the state minimum liability coverage. In many states, that might be just $25,000 for bodily injury. Mark's medical bills and lost wages alone are going to be $50,000 or more. The at-fault driver's insurance will pay out their maximum of $25,000, and that's it. They're done. You're left with a mountain of bills and no one to pay them. This is where underinsured motorist coverage kicks in. Covers the gap. If the other driver has $25,000 in coverage, but you have $100,000 in underinsured motorist coverage, your policy can pay up to an additional $75,000 to make you whole. It fills the gap left by someone who was technically following the law, but was so underinsured it was almost as bad as having no insurance at all. So that's the first pillar of protecting yourself. But let's keep going because there are other gaps. What if you're in an accident and it's not immediately clear who is at fault? Or what if you live in one of the dozen no-fault states? In these situations, it can take weeks, months, or even years for liability to be sorted out, and for an insurance company to pay your medical bills. But the hospital wants their money now. Your physical therapist needs to be paid now. You can't wait a year for lawyers to argue. This is where the next two coverages come in: medical payments, or MedPay, and personal injury protection, or PIP. Think of MedPay as a small, fast-acting fund for immediate medical expenses. It's usually sold in small amounts, $1,000, $5,000, maybe $10,000. The magic of MedPay is that it pays out immediately, regardless of who was at fault. If you have $5,000 in MedPay and you go to the emergency room with a $2,000 bill after an accident, you can submit that bill to your own insurance company and they will pay it right away. No arguments, no waiting. It covers you and any passengers in your car. It can even cover you if you're hit by a car as a pedestrian or cyclist. It's like a financial first aid kit. It's not meant to cover catastrophic injuries, but it's designed to handle those immediate copays, deductibles, and ambulance rides so you don't have to pay out of pocket while the bigger claims are sorted out. Personal injury protection, or PIP, is MedPay's bigger, more powerful sibling. In no-fault states, it's mandatory. In others, it's an optional add-on. And if it's available to you, it is one of the most valuable coverages you can buy. Because PIP goes far beyond just medical bills. Like MedPay, it pays out regardless of fault. But PIP also covers things MedPay doesn't, like lost wages. If you have a PIP policy with a lost wages benefit and you have to miss a month of work, your own insurance company will start paying a portion of your salary, often up to 80% right away. It can also cover what's called essential services. Let's say you're a stay-at-home parent and you break both your arms in a car accident. You can't take care of your kids, you can't clean the house, you can't cook. PIP can actually pay for things like hiring childcare or a cleaning service while you recover. It's designed to keep your life running when you physically can't do it yourself. It's an incredibly broad and powerful protection against the immediate, cascading chaos that a car accident can cause in your day-to-day life. So now look at the house we're building. The liability, collision, and comprehensive were the foundation and the frame. They protect you from the big, obvious disasters. But the uninsured motorist coverage, the MedPay, the PIP, this is the wiring, the plumbing, the insulation. This is what makes the house a truly safe and functional shelter. Without them, you have a structure that looks strong, but the first sign of a complex storm, an uninsured driver, a disputed fault accident, and you'll find yourself financially freezing in the dark. We have now protected your assets from lawsuits, protected your car from damage, and protected your body and your income from the irresponsibility of others and the immediate costs of an injury. You are now shielded from financial catastrophe, but we're still not done. Because surviving an accident isn't just about avoiding bankruptcy. It's also about navigating the massive, frustrating, and expensive inconveniences that come next. What happens at 2 a.m. when you're standing on the side of a highway and your car is undrivable? How do you get to work for the next 3 weeks while your car is in the shop? Your financial life might be safe, but your actual life is in disarray. And that's where the final layers of a truly full coverage policy come into play. These are the coverages that address the real-world chaos of an accident. They're not about the multi-thousand-dollar repair bill. They're about the $50 problem that can ruin your day, or the logistical nightmare that can derail your entire month. Let's start with the most immediate problem you're facing in our scenario. You're standing on the side of the road, your car is a wreck, and you can't get to work. Your first thought isn't about the repair shop, it's about the rental car counter. This is where rental reimbursement coverage, sometimes called rental car coverage or transportation expense, becomes your absolute best friend. It's exactly what it sounds like. If your car is in the shop for a covered claim under your collision or comprehensive coverage, your insurance company helps pay for a rental car. But here's the critical detail you need to understand. It's not a blank check. Rental reimbursement has limits, and they are usually expressed in two numbers, like 30/900. This is not insurance jargon. It's the rulebook for your temporary freedom. The first number, the 30, represents the maximum amount the insurance will pay per day. So, in this case, you get up to $30 a day for a rental. The second number, the 900, is the total maximum the policy will pay out for the entire rental period. So, you could rent a car for $30 a day for 30 days, hitting your $900 cap. Or, if you needed a bigger vehicle that costs $45 a day, your insurance would still only pay $30, you'd cover the extra $15, and you'd run out of your $900 total benefit in just 20 days. Now you might be thinking, $30 a day? I can find a deal like that. But can you really? In today's market, with rental car shortages and inflation, finding a reliable vehicle for $30 a day is becoming a fantasy. Even the smallest economy cars can easily run $40, $50, or even $60 a day, especially if you need it on short notice after an accident. If you have a family and need an SUV or a minivan to haul your kids around, that $30 a day limit will feel like a cruel joke. You could be paying $50 or more out of your own pocket every single day just to maintain your normal life. That adds up fast. Over a 3-week repair, you could be out over $1,000. This is why it is absolutely vital to look at your rental reimbursement limits. For just a few extra dollars per policy term, you can often upgrade your coverage from $30 a day to $40, $50, or even $60 a day. That small increase in your premium can be the difference between a minor inconvenience and a major financial headache. It transforms the coverage from a little help to a real solution. It's the difference between your life continuing as normal versus your life being dictated by the availability of the cheapest, smallest car on the lot. But before you even get to the rental counter, there's another problem. Your crumpled car is still on the side of the highway, and a tow truck driver is asking for your credit card. A tow, even for a few miles to the nearest body shop, can cost hundreds of dollars. If your car breaks down late at night or in a rural area, that price can skyrocket. This is where another small but mighty coverage comes in. Roadside assistance. Think of roadside assistance as the first responder of your insurance policy. It's an optional add-on that typically costs less than a single fancy coffee per month. Yet, for that tiny price, you get a 24/7 hotline for life's most common automotive frustrations. It almost always includes towing to the nearest qualified repair facility. So that $300 tow bill we just mentioned? It's covered, but it's so much more than that. Locked your keys in the car? Roadside assistance can dispatch a locksmith. Got a flat tire and you're not comfortable changing it on a busy interstate? They'll send someone to do it for you. Your battery dies in your garage on a cold Monday morning? They'll come give you a jump start. Run out of gas a mile from the nearest station? They'll bring you a few gallons to get you on your way. For a few dollars a month, you are buying peace of mind. You're buying a solution to a dozen different problems that could otherwise cost you hundreds of dollars and hours of stress. You're eliminating the panic of being stranded. So now your car has been towed to the shop, and you're in a rental car, all paid for by these two crucial coverages. Your financial life is stable, your daily life is back on track. But there's another, more personal element we haven't discussed. You and your passengers. What about the hospital bill from your checkup after the accident? What about the ambulance ride? Your health insurance might cover a lot of it, but what about your deductible? What about your copays? This is where the next layer of protection comes in, and it has two different names depending on where you live: medical payments coverage or MedPay, and personal injury protection or PIP. Let's start with MedPay because it's the simpler of the two. Medical payments coverage is an optional add-on that helps pay for medical and funeral expenses for you and your passengers after an accident, regardless of who was at fault. That last part is key. There's no waiting for the insurance companies to fight it out and determine fault. You go to the emergency room, you get the bill, and MedPay can help cover it right away. It's typically sold in set amounts like $1,000, $5,000, or $10,000. It acts as a primary or secondary form of health coverage specifically for car accidents. For many people, it's the perfect tool to pay for their high health insurance deductible. So if you have a $5,000 health insurance deductible, having $5,000 in MedPay means you won't have to pay a dime out of pocket for your medical care after a covered accident. It also covers your passengers, which can prevent an incredibly awkward or friendship-ending situation where you have to tell your friend they need to figure out how to pay for their own ER visit after a crash in your car. Now, if you live in what's called a no-fault state like Florida, New York, or Michigan, among others, the system is a bit different. In these states, the law requires you to carry personal injury protection, or PIP. PIP is like MedPay on steroids. It's mandatory and it's designed to be the primary payer for your injuries, regardless of fault. The goal of no-fault laws is to speed up the payment process and reduce lawsuits by having each driver's own insurance handle their own injuries first. But PIP goes way beyond just medical bills. This is its superpower. In addition to covering hospital visits, surgeries, and rehabilitation, PIP can also cover other economic losses. The most significant one is lost wages. If your injuries from the accident prevent you from working for a month, PIP can help replace a percentage of your lost income, keeping your family financially afloat while you recover. It can also cover things like hiring someone to perform essential services you can no longer do, like childcare or lawn maintenance. PIP is a comprehensive safety net designed to protect not just your health, but your entire financial well-being after an injury. So let's step back and look at the picture we've built. Liability coverage protects you from others. Collision and comprehensive protect your car. But it's these final pieces, rental reimbursement, roadside assistance, and MedPay or PIP, that protect your life. They ensure you can still get to work, that you aren't stranded on the side of the road, and that an injury doesn't also become a devastating financial crisis. This is the ecosystem of a truly full coverage policy. It's a fortress of protection with every wall reinforced. You've thought of everything, except for one terrifying variable you can't control: the other driver. What happens when the person who hits you has no insurance at all? Or they have the bare minimum state-required policy that can't even begin to cover the cost of your new car or your serious injuries? This is the single most terrifying gap in any driver's financial safety net. Because in that moment you did everything right. You were a safe driver. You bought a great car. You paid for insurance. But the person who crashed into you did none of those things. So who pays? Who makes you whole again? The answer is you do. Or rather, a specific part of your own policy does if you were smart enough to add it. This is where we introduce the unsung heroes of a truly comprehensive auto policy: uninsured and underinsured motorist coverages. Let's call them UM and UIM for short. Think of these coverages as your personal financial bodyguard. They step in to protect you from the fiscal irresponsibility of other people on the road. And believe me, there are a lot of them. The Insurance Research Council estimates that 1 in every 8 drivers in the United States is uninsured. That's over 12% of the cars you see on your daily commute. In some states like Florida, Mississippi, or New Mexico, that number skyrockets to 1 in 4. You are sharing the road with millions of ticking financial time bombs. Let's break down how this bodyguard works, starting with the most straightforward scenario: the uninsured driver. A person with zero insurance runs a red light and T-bones your brand new SUV. Your vehicle is a twisted wreck and you have a broken arm and a concussion. Your collision coverage, which we just discussed, will pay to repair or replace your SUV after you pay your deductible. Fantastic! But what about your arm? What about the ambulance ride, the emergency room visit, the orthopedic surgeon, the physical therapy? What about the 2 months of work you have to miss as a graphic designer because you can't use your dominant hand? Your health insurance might cover some of the medical bills, but it won't cover everything. It won't cover your copays, your deductibles, and it certainly won't pay you for your lost wages. And it will give you exactly $0 for the pain, the suffering, and the sheer trauma of the event. This is where uninsured motorist bodily injury, or UMBI, swoops in to save the day. UMBI coverage essentially stands in the place of the insurance the other driver should have had. It's your own insurance company paying you for your injuries, your lost income, and your pain and suffering, up to the limits you selected. You're not suing a ghost. You're not trying to get blood from a stone. You are filing a claim with your own company to use the protection you paid for. Now, some policies also offer uninsured motorist property damage, or UMPD. This is designed to cover your car if an uninsured driver hits you. You might be thinking, wait, didn't you just say collision coverage does that? And you're right, it does. The two can overlap. But here's the key difference. UMPD often has a much lower deductible than collision. So if you have a $1,000 collision deductible but a $250 UMPD deductible, you can use your UMPD to fix your car and only be out $250 instead of $1,000. In some states, UMPD is a mandatory part of the package, while in others, you can't even buy it if you already have collision. It's a regional nuance, but the core concept is protecting your vehicle from someone with no coverage. But here's the scenario that's even more common, and frankly more insidious. The underinsured driver. This is the person who did the absolute bare minimum. They went online, found the cheapest possible policy that would make them street legal, and bought it. In many states, the required minimum for bodily injury liability is just $25,000 per person. Let's think about that. $25,000. Have you seen a hospital bill lately? A single night in the hospital, an MRI, and a minor surgery can blow past that number before you've even been discharged. So let's replay our accident. The driver who T-boned you does have insurance. Their policy limit is $25,000. Your total medical bills plus your 6 weeks of lost income come out to $90,000. Their insurance company will write you a check for their policy limit, $25,000. And that's it. That's all they are legally required to pay. You are now left with a $65,000 hole. A $65,000 bill that is entirely your problem. You can try to sue the driver personally, but let's be realistic. If they could only afford the cheapest insurance on the market, what are the odds they have $65,000 in assets just sitting around for you to claim? The odds are virtually zero. This is the nightmare scenario where underinsured motorist coverage, UIM, becomes the most important financial decision you've ever made. Your UIM coverage kicks in after the other driver's insurance maxes out. It bridges the gap. In our example, their policy paid $25,000. You would then file a UIM claim with your own insurance company, and they would pay the remaining $65,000, assuming your UIM limit was high enough. It takes a catastrophic, life-altering financial disaster and reduces it to a manageable, albeit stressful, insurance claim. It is, without exaggeration, a financial lifesaver. Let me put this in the context of a real-life story. Imagine a woman named Jessica. She's a 35-year-old nurse, a mom of 2, and she drives a safe, reliable minivan. She has what she thinks is full coverage. She has high liability limits, she has collision, she has comprehensive. She's responsible. One afternoon, while driving her kids home from soccer practice, a speeding car trying to beat a yellow light slams into her. The other driver, a 20-year-old college kid delivering for a food app, has the state minimum $15,000 liability policy. Jessica suffers a serious back injury requiring surgery and months of rehabilitation. Her minivan is totaled. The total medical cost balloons to $120,000. She's out of work for 4 months, losing about $25,000 in income. Her total loss is $145,000, not to mention the chronic pain she'll have to manage for years. The kid's insurance pays its full limit, $15,000. That leaves a staggering bill of $130,000. Jessica and her husband are staring at bankruptcy. They might have to sell their home. Their savings are wiped out. Their kids' college funds? Gone. All because a stranger made a bad decision. Now let's rewind. Same accident, same injuries, same costs. But this time, when Jessica bought her full coverage policy, her agent advised her to add uninsured and underinsured motorist coverage, and to match it to her own liability limits of $250,000. Jessica, being smart, agreed. It added about $15 a month to her premium. In this reality, after the at-fault driver's insurance pays its $15,000, Jessica's lawyer files an underinsured motorist claim with her own company. Her policy then steps in and pays the remaining $130,000 to cover the rest of her medical bills and all of her lost wages. They may even provide additional compensation for her pain and suffering. Her family's finances are secure. They don't have to sell their home. Her life is still turned upside down by the injury, but it is not destroyed by the financial fallout. For the price of a few fancy coffees a month, she protected her family from utter ruin. That is the power of UM and UIM. It is not an exaggeration to say it is one of the most critical coverages you can buy. It is the shield that protects you from the single biggest variable on the road: other people. So when you hear the term full coverage, I want you to mentally add UM and UIM to that list. liability, collision, comprehensive, and uninsured/underinsured motorist. That is the four-legged stool of a truly solid auto insurance policy. Without it, you're just hoping that everyone else on the road is as responsible as you are. And statistics tell us that's a very, very bad bet to make. Now we've built the fortress. We've protected your assets from lawsuits, we've protected your car from damage and disaster, and we've protected your body and your bank account from the millions of irresponsible drivers out there. But what about the little things? The inconveniences? What happens when your car is in the shop for 3 weeks after an accident? How are you getting to work? What happens when you get a flat tire on a dark highway at midnight? These are the practical, everyday problems that a basic policy doesn't solve. And the answer to those questions lies in the fine print. It lies in the optional coverages that transform a standard policy into a real-world safety net. These aren't the big, famous coverages like liability or collision. Think of these as the supporting cast, the unsung heroes of your insurance policy that show up when you need them most. Agents don't always push them because they don't add a ton to your premium, but they add an incredible amount of value to your life. Let's break down the 3 most important ones that you absolutely need to know about. First up is the one that solves the "how do I get to work" problem: rental reimbursement coverage. This sounds simple, and it is, but its importance is impossible to overstate. Imagine this scenario. You're in an accident. It wasn't even your fault. The other driver's insurance is accepting liability, but your car is undrivable. The body shop is backed up. They tell you it's going to be a minimum of 3 weeks to get the parts and do the repairs. 3 weeks. 21 days without a car. Now think about your life. Do you have kids to drop off at school? A job to get to across town? Groceries to buy? Doctor's appointments? Life doesn't just stop because your car did. Without rental reimbursement, you're on your own. You're begging rides from friends, you're coordinating with your spouse, you're spending a fortune on Uber and Lyft, which adds up terrifyingly fast. It's a logistical and financial nightmare, and it's incredibly stressful. With rental reimbursement, the entire story changes. You make one phone call to your insurance company. They say, "No problem. We've got you covered." They set you up with a rental car from a major company like Enterprise or Hertz. You go pick it up, and for those 3 weeks you have a vehicle. You can get your kids to school. You can get to work. Your life continues with almost zero disruption. The insurance company pays the rental bill directly, up to your policy limits. Now, let's talk about those limits because this is critical. Rental coverage isn't a blank check. It's typically sold with a per-day limit and a total claim limit. You might see something like $30 per day, up to a maximum of $900. This means the policy will pay up to $30 a day for a rental, and the total payout for that single claim won't exceed $900. So, at $30 a day, that gives you 30 days of coverage. If you need a bigger vehicle like an SUV or a minivan to fit your family, you might want to opt for a higher daily limit like $50 or $60 a day. The difference in your premium is usually pennies, literally a few dollars a year, but the difference in your experience after an accident is monumental. It's the difference between chaos and calm. The second game-changing coverage answers the stranded on the highway at midnight problem. Roadside assistance, sometimes called towing and labor coverage. We've all been there. That gut-wrenching feeling when you turn the key, and all you hear is a click, click, click. Or you walk out of a store to see your tire is completely flat. Or even worse, you're driving on a dark road and the engine just stops. In that moment, panic sets in. Who do you call? How much is a tow truck going to cost at this hour? It can easily be $100, $200 or more just for the tow. Then you have to pay for the repair. It's an unexpected, expensive, and often frightening situation. Roadside assistance coverage is your one-call solution. It's like having a motor club membership, like AAA, baked directly into your car insurance policy, often for a fraction of the cost. For an extra $1 or $2 a month, you get a 24/7 hotline. You call them, give them your policy number and location, and they dispatch help immediately. A tow truck comes to take your car to a nearby mechanic. Someone comes to jumpstart your dead battery. They'll send a person to change your flat tire using your spare. They'll bring you a few gallons of gas if you run out. They'll even send a locksmith if you lock your keys in the car. It covers all those common, infuriating car problems that can ruin your day. This isn't just about money. It's about safety and peace of mind. Knowing that no matter where you are in the country, help is just one phone call away is an incredible feeling of security, and for the tiny cost, it's one of the single best values in the entire world of insurance. And that brings us to the third, and arguably the most crucial optional coverage, medical payments coverage, or as it's known in some states, personal injury protection. This one is about protecting people, not just property. We've focused a lot on what happens to the cars in an accident, but what about what happens to you and your passengers? Let's imagine you're in a crash. You have a broken arm and your friend in the passenger seat has a nasty case of whiplash. An ambulance is called. You both go to the emergency room. You get x-rays, treatment, and a bunch of prescriptions. A few weeks later, the bills start arriving. The ambulance ride alone is over $1,000. The ER visit is several thousand more. Who pays for this? You might think, well, the at-fault driver's liability insurance will pay. And you're right, eventually. But eventually is the key word. Insurance claims, especially injury claims, can take months, sometimes even years, to settle. The other company will investigate, they'll argue, they'll negotiate. In the meantime, those medical bills are due now. The hospital wants its money. Your health insurance might cover some of it, but you've got a high deductible, maybe $3,000 or $4,000 that you have to pay out of pocket first. So you're injured, you're stressed, and now you have thousands of dollars in medical debt piling up while you wait for the insurance companies to sort things out. This is the exact problem that medical payments coverage, or MedPay, is designed to solve. MedPay is your financial first aid kit. It pays for immediate medical expenses for you and anyone in your car, regardless of who was at fault for the accident. It doesn't matter if you caused the crash, or if the other driver did. You get hurt in your car, it pays. Period. It pays for the ambulance, the ER visit, the x-rays, your health insurance deductible, dental work if you injured your teeth, all of it, up to the limit you choose. Those limits are typically smaller, like $1,000, $5,000, or $10,000, because its job is to cover those immediate, upfront costs and bridge the gap until the bigger insurance settlements come through. There are no deductibles and no co-pays. It's fast, it's simple, and it ensures you can get the medical care you need right away without worrying about the cost. In some states, particularly no-fault states, you'll have something even more powerful called personal injury protection, or PIP. PIP does everything MedPay does, but it goes even further. On top of medical bills, PIP can also cover lost wages if your injuries prevent you from working. It can even cover things like hiring someone to help with household chores or childcare if you're laid up. It is an incredibly robust coverage designed to keep your entire life from derailing because of an injury. So let's put it all together. The term full coverage is a myth. There is no such policy. When people say it, they usually just mean they have liability plus collision and comprehensive. But a truly protective policy, the kind that gives you genuine peace of mind, is one that's been customized with these essential add-ons. It's a policy that not only fixes your car, but also gives you a rental to drive, a tow truck when you're stranded, and pays your medical bills immediately after a crash. This is what it means to be properly insured. So now we've built a truly robust policy. It covers the other car, it covers your rental, your tow, and your medical bills. You're completely protected, right? Well, not quite. There's one giant, terrifying risk we haven't talked about yet. What happens when the person who hits you has no insurance at all? It's one of the most sickening feelings you can have behind the wheel. The screech of tires, the jolt of impact, and the sudden sharp silence that follows. You take a deep breath, you check yourself, you're okay, just shaken. You get out of the car and see the damage. The other driver is getting out too, looking distraught. They ran a red light, plain and simple. It's clearly 100% their fault. After you both confirm nobody needs an ambulance, your training kicks in. You exchange information. And that's when the driver looks at the ground, shuffles their feet, and mumbles the 6 words that can turn a bad day into a financial catastrophe. I don't have any insurance. Your stomach drops. But then a wave of relief washes over you. You did the responsible thing. You have full coverage. You're protected. You'll just call your own insurance company, and they'll handle it. They'll fix your car, they'll cover your doctor's visit for that whiplash that's starting to set in, and they'll go after the other driver for the money. That's how it works, right? You make the call, explain the situation, and your agent is very sympathetic. They say, okay, we can definitely get your car repaired under your collision coverage. You'll just need to pay your deductible first. You agree, that's fine. But then you ask, and what about my medical bills? My neck is really starting to hurt, and I might miss a few days of work. And then comes the pause. The pause you never want to hear from an insurance agent. And they say something that makes no sense. They say, well, your policy doesn't cover your medical bills in this situation. You're confused. You say, What are you talking about? I have full coverage. I have bodily injury liability with huge limits. And the agent has to deliver the devastating news. Sir, ma'am, your bodily injury liability coverage, that's for when you hurt someone else, pays for their medical bills. It doesn't cover your own. In that moment, the entire concept of full coverage shatters. You realize you've been driving around with the gaping hole in your financial armor. The at-fault driver has no insurance, and therefore no ability to pay for the damage they caused. Your own liability insurance won't pay for your injuries. So who does? You do. Your health insurance might cover some of it after you pay your deductible and copays, but it won't cover your lost wages. It won't cover the physical therapy you'll need for the next 6 months. And it certainly won't offer you a single penny for your pain and suffering. You're the victim, but you're left holding all the bills. This isn't some rare freak accident. This happens every single day. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States is uninsured. That's almost 13% of all drivers. In some states, it's far worse. In Mississippi, it's nearly 1 in 4. In Florida, New Mexico, and Tennessee, it's 1 in 5. Think about that. On your daily commute, you will likely pass dozens, if not hundreds, of drivers who have absolutely no way to pay for the damage they might cause you. They are financial time bombs on wheels. So how do you protect yourself from this? This is where we add 2 of the most important and most misunderstood layers to your policy. This is the coverage that truly separates a basic policy from a fortress of protection. We're talking about uninsured and underinsured motorist coverage. Let's break it down. First, uninsured motorist coverage, or Think of it this way. Since you can't force every driver to be responsible, coverage is you buying an insurance policy for the uninsured guy in case he hits you. It's a backup plan you buy for yourself. Comes in 2 critical parts. The first part is uninsured motorist bodily injury, or UMBI. This is the hero of our story. If an uninsured driver hits you and you're injured, this is the coverage that steps in and acts like the insurance they were supposed to have. It pays for your medical bills, your ambulance ride, your hospital stay, your follow-up appointments. It pays for your lost wages if you can't work. And crucially, it also pays for pain and suffering, which can be a significant part of a settlement if your injuries are severe. Without UMBI, you get none of that. You get stuck with the bills. With UMBI, your own insurance company pays you, and then they get the thankless job of trying to sue the uninsured driver to get their money back. But you're already taken care of. The second part is uninsured motorist property damage, or UMPD. This, as the name implies, covers the damage to your car if it's hit by an uninsured driver. Now you might be thinking, wait, doesn't my collision coverage already do that? And you're right, it does. So why have UMPD? 2 reasons. First, the deductible on UMPD is often much lower than your collision deductible. It might be $250 instead of $1,000, saving you a good chunk of cash. Second, in some states, making a claim under UMPD is considered a not-at-fault accident and is less likely to raise your rates than a collision claim would be. However, UMPD isn't available in every state, and if you have collision coverage, it can sometimes be redundant. It's a conversation to have with your agent. But uninsured motorist bodily injury is non-negotiable. It is an absolute must-have. Now for the second, sneakier part of this problem, the underinsured motorist. This might be even more dangerous because it gives you a false sense of security. Let's go back to our crash scene. But this time, the at-fault driver proudly pulls out an insurance card. You breathe a sigh of relief. You exchange information, you file a claim with their company, and everything seems to be going smoothly. Their insurance company accepts full liability, but then your medical bills start rolling in. The crash was worse than you thought. You needed surgery on your shoulder. The total cost is $100,000, not including the 2 months of work you had to miss. You send the bills to the other driver's insurance company, and they send you a check for $25,000. Not a penny more. You call them, furious, and they calmly explain that their client, the driver who hit you, only purchased the state minimum liability coverage, which in their state is $25,000 for bodily injury. That's all they are legally required to pay. That's the entire limit of the policy. They're sorry, but their obligation is fulfilled. You are now left with $75,000 in medical bills and lost wages, and no one to pay for it. The at-fault driver had insurance, but it was so little, it was practically useless for a serious accident. This is where underinsured motorist coverage, or saves the day. UIM coverage kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover your bills. In our example, their insurance paid the first $25,000. Then your UIM coverage would activate to cover the rest, up to the limit you selected. If you had $100,000 in UIM coverage, it would pay the remaining $75,000. It bridges the gap between the damage they caused and the tiny policy they carried. So here is the critical lesson. Full coverage means nothing if you have declined uninsured and underinsured motorist coverage. In many states, this coverage is optional, and agents might even encourage you to waive it to get a lower price. Do not do it. This is the one place you cannot afford to cut corners. So what do you do right now? I want you to pause this video, find your auto insurance policy declaration page. That's the summary of your coverages, and look for 2 lines. Uninsured motorist bodily injury, UMBI, and underinsured motorist bodily injury, UIM. First, see if you even have them. If you don't, your homework is to call your agent today and add them. Second, look at the limits. A common rule of thumb is to have your UM/UIM limits match your own bodily injury liability limits. If you have decided you need $100,000 of liability coverage to protect your assets when you hurt someone else, why would you accept less than that to protect your own family if someone else hurts you? The cost to add or increase this coverage is often shockingly small for the monumental protection it provides. We're talking a few dollars a month in many cases. It is the single best bargain in the world of insurance. Because when that crash happens and you're standing on the side of the road watching smoke curl up from your engine, the question you'll be asking yourself isn't, do I have insurance? It's, do I have the right insurance? You've now built a policy that protects you from your own mistakes, and from the mistakes of the uninsured and underinsured. Your fortress is almost complete. You've got the big walls built. But what about the day-to-day hassles? What happens when your car is in the shop for 2 weeks? Who pays for the rental? What happens when you get a flat tire on a dark highway? These aren't million-dollar problems, but they can turn a minor incident into a logistical nightmare. And your core coverage doesn't handle any of it. This is where the insurance industry gets a little creative. These gaps are plugged not by your core policy, but by a series of optional add-ons, officially called endorsements or riders. Think of them like downloadable content or DLC for your insurance policy. You're buying small, specific upgrades to handle very specific problems. And this is where a good policy becomes a great one. Let's start with the most common one: rental reimbursement coverage. Your car is in the shop after a covered accident. The mechanic says it'll be 10 days. Your core policy pays for the repairs, but it does not pay for you to get to work for those 10 days. You're on your own. You could Uber everywhere, costing you hundreds of dollars, or you could rent a car, also costing hundreds. But if you have rental reimbursement coverage, your insurance company steps in. They will pay for a rental car while yours is being fixed. Now, it's not a blank check for a Ferrari. A typical policy might offer something like $30 a day for up to 30 days, so a total of $900. You might see it written as 30 of 900. You can usually pay a little more for higher limits, like $50 or even $75 a day, which is crucial if you need a larger vehicle like an SUV or a truck to fit your family or your work gear. For the price of a couple of coffees a month, this single add-on can save you from a massive headache and a huge out-of-pocket expense. It turns a crisis into a mere inconvenience. Next up, let's talk about that flat tire on a dark highway. This is where roadside assistance coverage comes in. It's another one of those incredibly cheap add-ons that feels like a magic trick when you need it. You get a flat? They send someone to change it. Your battery dies in your garage on a cold Monday morning? They send someone for a jump start. Lock your keys in the car? They'll send a locksmith. Run out of gas a mile from the exit? They'll bring you a few gallons. And most importantly, if your car breaks down and can't be fixed on the spot, it covers the tow to the nearest qualified repair shop. Let's put that in perspective. A single tow, depending on the time of day and how far you are, can easily cost $150, $200, even $300 or more. A full year of roadside assistance coverage on your policy might cost you just $15 or $20 total for the whole year. You use it just once and it has paid for itself for the next decade. It's one of the highest value for money propositions in the entire insurance world. Now for a big one that can save you from financial ruin, especially if you have a newer car. It's called gap insurance. The gap it covers is the one between what your car is worth and what you owe on your car loan or lease. This concept is so important, so let's walk through a story. You just bought a brand new SUV for $40,000. You made a small down payment, so you have a loan for $38,000. You drive that beautiful car off the lot, and in an instant its value drops. That's depreciation. A month later, after making your first payment, you still owe about $37,500. But because it's no longer a new car, its actual cash value, what an insurance company would pay you for it, is now only, say, $32,000. Then disaster strikes. Someone runs a red light and totals your car. Your collision coverage kicks in, and your insurance company does exactly what they're supposed to do. They write you a check for the actual cash value of your vehicle, $32,000. Here's the problem. You take that $32,000, you give it to the bank, but you still owe them $37,500. You are now left with no car, and a bill for $5,500. You have to keep making payments on a vehicle that is now a pile of scrap metal. That $5,500 difference is the gap. And gap insurance is designed specifically to pay that off. It pays the difference between the insurance payout and your remaining loan balance, saving you from a devastating financial hit. If you are leasing a car or buying a new car with a small down payment, gap insurance isn't just a good idea. It is an absolute necessity. Okay, let's move on to an add-on that protects you from the irresponsibility of other drivers. Uninsured and underinsured motorist coverage. We'll call it UM/UIM. The statistics are chilling. Depending on your state, as many as 1 in 4 drivers on the road with you right now has zero insurance. Absolutely none. And many more are driving with the absolute bare minimum coverage required by law, which might only be $25,000 for bodily injury. So imagine you're sitting at a stoplight, and one of these uninsured drivers slams into the back of you. It's 100% their fault. You're injured, you have $80,000 in medical bills, and you can't work for 2 months. You try to get their insurance information, and they either have none, or they have a policy that will only pay a fraction of your costs. What do? Sue them personally? Good luck collecting money from someone who couldn't even afford basic insurance. This is where uninsured motorist coverage becomes your hero. It steps in and acts like the other driver's insurance. It pays for your medical bills, your lost wages, and your pain and suffering, up to the limits you selected. Underinsured motorist coverage works similarly. If the at-fault driver has insurance, but their $25,000 limit isn't enough to cover your $80,000 medical bill, your UIM coverage can kick in to cover the remaining $55,000. In a world where a single trip to the emergency room can cost tens of thousands of dollars, UM/UIM is the critical shield that protects your health and your finances from other people's bad decisions. Finally, there are 2 more quick but important coverages: medical payments or MedPay and personal injury protection or PIP. They are similar but have key differences. MedPay is simpler. It's an optional coverage in most states that pays for the medical expenses for you and your passengers after an accident, regardless of who was at fault. There's no deductible. If you have a $5,000 MedPay limit and you have a $2,000 hospital bill, it just gets paid quickly. It's like a small immediate health insurance fund specifically for car accidents. Personal injury protection or PIP is required in no-fault states and optional in others. It's like MedPay on steroids. It not only covers medical bills for you and your passengers regardless of fault, but it can also cover other related expenses, like lost wages if you can't work, and even services you might need to hire like childcare while you recover. It's designed to get you back on your feet financially as quickly as possible without having to wait for a long, drawn-out fault determination process. So you see, full coverage isn't a single product. It's a custom-built fortress. Liability is the outer wall protecting others. Collision and comprehensive are the strong keep that protects your castle. And all these add-ons, the rental car coverage, the roadside assistance, the gap insurance, the protection from uninsured drivers, they are the sentries on the wall, the emergency supplies in the cellar, the hidden escape tunnels. They are the details that turn a basic shelter into an impenetrable stronghold. You choose which ones you need based on your car, your finances, and your life. You've essentially assembled your perfect policy, a custom-built suit of armor. But there's one final crucial step. How thick does the armor need to be? How much is enough? Choosing your coverage limits and your deductibles is arguably the most important financial decision you'll make. A $500 deductible versus a $2,000 one. A $100,000 liability limit versus a $1 million one. These numbers aren't arbitrary. They are the difference between being truly protected and being dangerously exposed. And getting them right is the final piece of the full coverage puzzle. So how do you get them right? How do you take all this knowledge, liability, collision, comprehensive, deductibles, and limits, and transform it from abstract concepts into a real policy that protects your life. This is where the rubber meets the road, literally. This is the action plan. You now know what to buy. Now we're going to cover exactly how to buy it, how to find the best price without sacrificing a single ounce of protection, and how to avoid the traps that cost unsuspecting drivers thousands. The first and most dangerous trap is the myth of the cheapest insurance. We're all conditioned to hunt for the lowest price. But with insurance, the cheapest option is almost always a mirage. It looks good on paper, but it vanishes when you need it most. A policy is not a product, it's a promise. A promise that a company will be there with a massive check when your life has been turned upside down. And some companies are much better at keeping that promise than others. Before you even look at a single price, you need to do a 5-minute background check on the companies you're considering. Is this company known for fighting its customers tooth and nail over every claim? Or are they known for paying quickly and fairly? A simple search for insurance company name J.D. Power Claim Satisfaction Rating is a great start. J.D. Power is an independent organization that ranks companies based on real customer feedback on the claims process. A company that consistently ranks near the top is likely a safer bet than one that's always at the bottom. Another pro-level move is to check a company's financial strength rating from a service like AM Best. This tells you if the company actually has the money to pay out claims, especially after a major catastrophe like a hurricane or wildfire. You want a company with an A rating or higher. It sounds technical, but it's just a report card on their financial health. A cheap policy from a company on shaky financial ground is one of the riskiest bets you can make. Once you've identified a handful of reputable companies, it's time to shop. And this brings us to the second myth, the loyalty myth. People think if they stay with the same insurer for 10 years, they're getting the best deal. The hard truth? That's rarely the case. Insurance pricing is incredibly complex. Insurers use hundreds of data points to calculate your risk, and these calculations change constantly. The company that was cheapest for you 3 years ago might be one of the most expensive for you today. The only way to know is to shop your policy at least every 1 to 2 years, or anytime you have a major life change like moving, getting married, or buying a new car. It takes an hour of your time and it can save you hundreds, sometimes even over $1,000 a year, for the exact same coverage. So let's get tactical. You're ready to get quotes. First, you need to gather your arsenal of information. You'll need the vehicle identification number, or VIN, for every car you want to insure. You'll need the driver's license number for every driver in your household. You'll need to be honest about your driving history. Any tickets or accidents in the last 3 to 5 years. They're going to find out anyway when they run your record, so being upfront prevents surprises. Finally, have a realistic estimate of how many miles you drive each year. Now, you have 2 main ways to get quotes. You can go direct to the insurance companies themselves. Think of the big names you see on TV. You go to their website, fill out their forms, and get a quote. The other path is to use an independent insurance agent. An independent agent doesn't work for one single company. They work with dozens. You give them your information once, and they do the shopping for you, bringing back quotes from multiple carriers. There are pros and cons to both. Going direct can sometimes be faster, but an independent agent can often find hidden gems from smaller, solid companies you've never heard of, and can provide personalized advice. The best strategy? Do both. Get a couple of quotes directly online and also call one independent agent. Your goal is to get at least 3 to 5 quotes. This gives you a clear picture of the market. And this leads us to the single most critical step in the entire process. The one place where almost everyone makes a mistake. You must compare apples to apples. You cannot just look at the final monthly price. Let me say that again, do not just look at the price. Imagine you get 2 quotes. Company A is $180 a month. Company B is only $130 a month. It seems like a no-brainer, right? Save $50 a month. But then you look closer. You pull up the quote documents side by side. You see Company A, the more expensive one, quoted you the 100/300/100 liability limits we talked about. They included uninsured motorist coverage. They quoted a $500 deductible for your collision and comprehensive. Then you look at Company B, the cheaper one. You realize they quoted you the bare-bones state minimum liability, maybe just 25/50/25. They completely left off uninsured motorist coverage. And they set your collision deductible at $2,000 to make the price look lower. This is not a cheaper policy. It's a worse policy. It's a dangerously inadequate policy that just happens to cost less. They are not the same thing. When you get quotes, you are the director. You tell them exactly what you want. You say, I want a quote for 100/300/100 liability. I want matching limits for uninsured motorist. I want a $500 deductible on collision and comprehensive. And I want $10,000 in medical payments coverage. You give every single company the exact same script. Only then, when you have 5 quotes in front of you with identical coverages, can you truly compare the prices. Once you have your apples-to-apples quotes, the game isn't over. Now it's time to hunt for discounts. Insurers have dozens of discounts, but they often don't apply them automatically. You have to ask. This is where you can claw back a significant amount of money. First, the biggest one, bundling. If you have homeowners or renters insurance, getting it from the same company as your auto insurance can often unlock a massive discount, sometimes 15 to 25%. Next, ask about driving-related discounts. Do you have a clean record with no accidents or tickets? That's a good driver discount. Did you take a defensive driving course? That's a discount. Are you a student with a B average or better? That's a good student discount. Then there are vehicle-based discounts. Does your car have anti-lock brakes, airbags, daytime running lights, or an anti-theft system? Each of those can be a small discount that adds up. Think about your life and habits. Do you work from home or have a short commute? Ask for a low-mileage discount. Are you a member of a certain profession? Many companies offer discounts for teachers, engineers, scientists, nurses, and military members. Are you part of an alumni association or a club like AAA? Ask about affiliation discounts. Finally, ask about policy-level discounts. Can you get a discount for paying your entire 6-month or 1-year premium upfront instead of monthly? Almost always, yes. Can you get a discount for going paperless and signing up for automatic payments? Usually. You need to go down the list with the agent or on the final quote page and ask, am I receiving every single discount I qualify for? Be your own advocate. Don't leave free money on the table. After you've done all this, you've vetted the companies, you've gotten multiple apples-to-apples quotes, and you've hunted down every last discount. Now and only now can you make your final decision. You weigh the final price against the company's reputation for customer service and claims handling. Sometimes it's worth paying $5 more a month for a company with a stellar reputation because that $5 buys you peace of mind. It buys the confidence that when you make that dreaded call after a crash, the person on the other end is there to help, not to fight. You've built your fortress. You've chosen the right materials, set the right limits, and negotiated the best price. You are now truly fully covered. But buying the policy is just the beginning. The real test comes when you actually have to use it. What happens in the chaotic moments after an accident? What are the exact steps you need to take to ensure your claim is paid? And what are the hidden mistakes that can get even a perfect policy denied? That's the final crucial chapter we need to cover. Let's build your post-accident playbook, step by step, turning chaos into a clear, manageable process. The moment the impact happens, your adrenaline spikes. Your first thought isn't about insurance, it's about safety. And that's exactly right. Before you even think about a policy number, your only job is to ensure everyone's physical well-being. If you can, move your vehicle out of the flow of traffic to a shoulder or a nearby parking lot. Turn on your hazard lights immediately. Take a deep breath and check yourself for injuries, then check on your passengers. Only when you've determined your immediate area is safe should you check on the occupants of the other vehicle. The very first phone call you make isn't to your agent, it's to 911. Always. Even if the accident seems minor, calling the police is non-negotiable. A police report is an impartial, official record of the incident. It documents the time, location, conditions, parties involved, and often includes a preliminary assessment of what happened. For an insurance claim, a police report is pure gold. It removes the he said, she said element and provides a credible foundation for your claim. While waiting for the police, the next phase begins: information gathering. This is where you must be calm, methodical, and careful with your words. The single most important rule in this moment is this: do not admit fault. Do not apologize. Do not say I didn't see you or I'm so sorry. In the high-stress environment of an accident, these are natural human reactions, but in the world of insurance and liability, they can be interpreted as an admission of guilt that can torpedo your entire claim. Be polite, be cooperative, but be silent on the matter of fault. Instead, focus on gathering the facts. Use your phone. Take a picture of the other driver's license, their insurance card front and back, and their license plate. Make sure you get their name, address, phone number, their insurance company, and their policy number. Also, get the names and contact information of any witnesses who saw what happened. A neutral third-party witness can be the deciding factor in a disputed claim. Now, you become a detective. Your smartphone is your most powerful tool. Document everything. Start with wide shots of the entire scene, showing the position of the cars relative to each other and to the road. Capture traffic signs, signals, and any skid marks on the pavement. Then get closer. Take multiple photos of the damage to both vehicles from every possible angle. Close-ups of specific impacts and wider shots showing the damaged areas in context. Photograph the other car's damage just as thoroughly as your own. Open your video app and do a slow walk-around of the entire scene, narrating what you see. The more evidence you collect, the stronger your position will be. You are building an undeniable, time-stamped record of events that will protect you from anyone trying to change their story later. Once the police have left and you are safely away from the scene, it's time to make the second critical call. To your insurance company. Most insurers have a 24/7 claims hotline or a feature in their mobile app. Use it. Report the claim as soon as you possibly can. The longer you wait, the more it can look like your claim isn't serious, or that you're trying to hide something. You'll be asked to provide all the information you just gathered. This is where your meticulous documentation pays off. You'll give them the other driver's details, the police report number, and you can start uploading the photos and videos you took. A key question people have is, should I call my insurance company or theirs? The answer is, you call your company. Always initiate the claim with your own provider. Even if the accident clearly wasn't your fault, you pay them for a service, and that service includes helping you navigate this exact situation. They can act as your advocate, a process called subrogation, where they pay for your repairs up front using your collision coverage, and then go after the other driver's insurance company for reimbursement. This is often much faster and less stressful than trying to deal with the other person's insurer directly, who has zero financial incentive to help you quickly. Soon after, you'll be contacted by an insurance adjuster. It's vital to understand the adjuster's role. Whether they are from your company or the other drivers, their primary job is to investigate the claim and determine the company's financial liability. They are not your friend. They work for the insurance company. Be honest, be cooperative, but be precise. Stick to the facts of the accident. Don't speculate or offer opinions. If they ask to take a recorded statement, you have the right to say you'd like to prepare first. Review your notes and the photos you took before you give any official statement. Your goal is to provide them with the clear, factual information they need to validate your claim, based on the evidence you've collected. Next comes the repair process. The adjuster will assess the damage to your vehicle, either in person or through photos you submit, and create an estimate. Here's a critical piece of information many people don't know. In most states, you have the legal right to have your car repaired at any shop you choose. The insurance company cannot force you to use one of their preferred or network shops. They might strongly encourage it, often by mentioning that the repairs will be guaranteed if you use their partner. While these network shops can be convenient if you have a mechanic you trust, you can and should insist on taking your vehicle to them. Simply give the adjuster your chosen shop's information. The shop will then negotiate the cost of repairs directly with the insurance company. But what if the damage is severe? What if the adjuster calls and says your car is a total loss? This means the cost to repair the vehicle exceeds its value. The insurance company won't pay for repairs. Instead, they will pay you the actual cash value, or ACV, of your car and take possession of the vehicle. ACV is the market value of your car the moment before the accident occurred. This is one of the most contentious parts of any claim, because the insurer's initial offer might seem low. Do not simply accept the first number they give you. This is where you can and should negotiate. Do your own research. Go to sites like Kelley Blue Book, Edmunds, and local car dealership websites. Find several examples of cars that are the same make, model, year, and condition as yours, for sale in your immediate geographic area. This is your evidence. Present these comps to the adjuster to justify a higher valuation. A little bit of homework here can put hundreds, or even thousands of extra dollars in your pocket. And if you have that gap insurance we talked about, this is when it kicks in to pay off the difference between the ACV and what you still owe on your loan. Finally, let's lock in this knowledge by highlighting the critical mistakes that can get a legitimate claim denied. First, waiting too long to report it. Your policy is a contract with a clause that requires timely reporting. Second, as we've stressed, admitting fault at the scene. This can stop a claim dead in its tracks. Third, not getting a police report. Without it, the claim becomes a messy dispute of one person's word against another's. Fourth, a lack of documentation. If you have no photos or evidence, you're making it much harder for your insurer to fight for you. And fifth, exaggerating your claim. Never, ever lie about the extent of the damage or injuries. That's insurance fraud, and it carries severe consequences far beyond just having your claim denied. We've come a long way on this journey together. From defining the myth of full coverage to understanding the bedrock of liability, and then building your protection with collision and comprehensive. We've navigated the maze of deductibles, unpacked the power of add-ons like rental reimbursement and uninsured motorist coverage, and now we've built a concrete plan for the most stressful moment of all, the aftermath of an accident. The goal was never just to define terms. It was to transfer knowledge, to demystify a system designed to be confusing, and to put you in a position of power. You now understand your policy not as a bill you have to pay, but as a powerful tool you control. You are now in the driver's seat, not just of your car, but of your financial protection. The peace of mind that comes with that knowledge is the best coverage of all.